In this video, I want to show you once again how the same patterns tend to appear between price and the pitchfork when we detect a market edge. Before getting into more detail, it's important to remember that this is a scenario known as running flow in the fractal flow methodology jargon. That means this analysis cannot be replicated all the time in all market scenarios as price shifts. That's why it's so important to make a contextual reading of price first to detect that type of scenario. The line work, which is the easy part, comes as a second layer that adds to the contextual analysis. From number 1 to number 5, we have two major opposing price vectors, the 1-2 vector and the 2-5 vector. Using the lens of the major flow, these two are similar in magnitude, but their composition is different. Observe that the 1-2 vector has smaller oscillations over its course, while the 2-5 vector can be decomposed to a more significant minor flow formed by the vectors 2-3, 3-4, and 4-5. Notice that the 2-5 vector comes back to the supply zone outlined by high number 1. It's interesting to notice the magnitude of the selling pressure in that supply zone once price enters it in number 5. The bar that makes that process clear is a large hybrid bar with an enormous upper tail and a fractal inflection point as well. However, within the minor flow inside the 2-5 vector, we also have a higher high in number 5 and a solid market extreme in number 4. That simply means a demand zone around low number 4. Here we come at the important part of the analysis, which is observing the counterpoint between buyers and sellers. In any professional price action analysis, there is the need to detect the market player who is dominant or the one who appears to have more power over the other. Sometimes that process is very obvious, and sometimes the market players appear to have more or less the same amount of power. In the first case, we have a strong trend. In the second, we have a sideways market. In this chart, it's not obvious which of the market players is indeed dominant if we look at the volatility of the bars for both sides of the market. In other words, bullish bars and bearish bars have roughly the same degree of volatility. Another sign of a sideways move is the fact that price retraces deeper into supply in the band zones. In a strong trending market, it's common for price to make very short retracements and completely miss the supply in the band zones. This is one of the reasons why sideways markets are relatively easier to trade than strong trending markets. The sweet spot is something in between a strong trending market and a sideways market, which would be something like a running flow with a mild angle. In that case, price retraced deep enough to reach the security of supply and demand zones, and it also progresses with good volatility without becoming trapped within a price range as it happens in a sideways market. With that said, notice that the 5-6 vector retraces deep into the demand zone in number 4. It's at this point that we can start thinking about the line work that goes beyond simple horizontal lines. If we draw a pitchfork using high number 3, low number 4, and high number 5 as the axes, we'll notice that the 5-6 vectors lands on the center line of the pitchfork. It's important to understand why I use these three axes to draw the pitchfork, as there is nothing random about them. These were the three axes used simply because they were the most recent and most significant price extremes in the chart. They are literally the most relevant peaks. That's what should guide your decision when trying to draw pitchforks. You don't just pick highs and lows randomly. Another detail here that will be considered an advanced interpretation is the fact that this downward pitchfork has some validation in its tail. When there is a frequency along the tail of the pitchfork, it means that the pitchfork is, beyond all else, detecting a Newtonian extrapolation between the B and C axes. From the perspective of econophysics, this is a strong confirmation of the alignment between the pitchfork and price. Some people believe that all pitchforks are created equal, so to speak. So the moment they learn about it, they start drawing pitchforks everywhere without really thinking about what they're doing. This obviously doesn't work because if it was that easy to use pitchforks to understand price, every trader on the planet would be doing that at this point. Unfortunately for some, this is about attention to detail and nuance. There is not a mechanical way of using pitchforks that guarantees that you won't need to think about anything. In fact, this is a problem with any type of analysis. This unwillingness to think for a moment is one of the worst things in trading because it keeps alienating people. Good price action analysis is like any other type of analysis, like fundamental or quantitative. There is a good amount of detail and nuance, and you can't reduce it down to the level of a child's play. Unfortunately, many grown adults attempt to do that without even realizing it. Anyway, back to the analysis. Since we have the 5-6 vector landing on the center line of the pitchfork, which has frequency along its tail, and the whole relationship of Newtonian extrapolation between the B and C axes, we can also see that this landing, so to speak, happens within the demand zone of low number 4. From this point, we can risk the assumption that 6 is indeed a major low. And yes, it's a risk because we cannot be sure about that, and we cannot avoid risk in the markets. It's all about minimizing the risk, not ignoring it. Notice that there is a tremendous difference between assuming number 6 is a major low and doing that randomly just because you were able to draw a pitchfork. There's a whole context and a logical narrative behind my assumption, which is the exact opposite of random. If we draw a pitchfork using low number 4, high number 5, and the possible low number 6 as the C-axis, we'll see that an upward pitchfork is generated, and its lower line can represent a chance to get in a long trade. It's important to realize that there is a good place to put a stop loss order below number 4 and a dynamic target at the center line of this pitchfork. A dynamic target is interesting because it increases the potential reward as the time of exposure in the market increases. That's interesting for a few mathematical and statistical reasons that are beyond the scope of this video. So let's advance price to see what happens. Here we can see that the upward pitchfork is successful in determining the edges of price. We can see that price touches the lower line of the pitchfork 5 times before it takes off to the center line. Before price takes off, it creates a last hybrid bar that hugs the lower line of the pitchfork without violating it, at the same time that it touches both the upper and lower limits of the demand zone of low number 4. If we stop to analyze the final risk-reward ratio of this trade, we will see that it's something around 1:4, which is extremely good. So that's it for this video. If you wish to learn professional trading methodologies, check out my courses in the links available in the video description. If you like the videos I do, please help support the channel by clicking the like button, subscribing to the channel, activating the notifications button, sharing the video with your trading community, and leaving your feedback below in the comment section. Thank you for watching. Take care.